Evan Feigenbaum joins us from Eurasia Group. You, of course, know Ian Bremmer. And Evan, great to have you here. You just put out a thick report on China and rebalancing. What is the Surveillance Midday Executive 2-second summary?
Well, I think that China really, in a lot of ways, is hitting the upper limit of the growth model that's been so successful for the last few decades. That's a growth model that's depended really on two pillars, exports and a lot of investment in fixed assets. And in a lot of ways, both of those pillars are vulnerable. And so we see it delivering really diminishing returns to China over time. And what's more, we think China's leaders know that. And so they're committed to rebalancing. Right. But they're going to meet some obstacles along the way.
Well, the Chinese leaders are committed to employing X amount of people every month. How are employment, how are labor trends in China, given where they are now and given the need to rebalance?
Well, I think they're changing. I mean, if you think about what a rebalanced China would look like over time, it's really a slower growth, higher inflation world in which subsidized land and subsidized energy prices will change, but also the cost of labor is going to rise. So, for instance, if you're a manufacturer that manufactures in all of those workshops in coastal China, you're going to face in many ways a changed landscape in which you can either look at other countries or you can look at interior central China as China begins to move up the value chain. So for your Chinese laborers along the coast, that'll have a salutary effect on their wages. But the overall labor picture in China, I think, is going to change in some very important ways.
Are we still losing jobs to China? Can that cliche of 2004 still apply? Are we losing jobs to Asia, to China?
Yeah, I think in some sectors, but I also think the nature of competition with China is changing in some important ways. You know, one thing that China is trying to do by rebalancing is really to move its industry up the value-added chain, and that's happening in many sectors much faster and much earlier than many people expected. So at Eurasia Group, for example, a lot of my corporate clients who designed their China strategies over a decade ago, they thought they had a deal. And the deal was they would transfer technology to China in exchange for market share. But now they're now fighting their Chinese partners for market share in China. Right. And what's more, as China moves up the value chain, they're becoming competitors globally.
Interesting.
So, that creates some opportunities, but it also creates a different kind of competition.
That's a really nice dynamic. How much of the turmoil of Europe and the United States, how much is that affecting China?
You mean what's happening globally? I think the Chinese are concerned. You know, I mean, they've weighed in on American debt in various ways with comments and various statements. But I think the bottom line is what the Chinese really have to wrestle with is whether and how they want to change the growth model they've had. You know, I mean, we don't see a lot of sign that they're going to be looking to liberalize the capital account or liberalize interest rate policy. And so with that kind of structural policy, it really puts a lot of constraints on what they can do. So ironically, the debt story in the U.S. has created a little bit more of an impulse to rebalancing in China.
Interesting. Here's a constraint. Let's bring it up right now. The immovable force, and that is China inflation. So different from ours. You can see that surge from true price decline, true deflation, and up we go, really beginning to touch that food crisis 2008 level. What is the character of their inflation? What do we need to know about China inflation that's different from developed world inflation?
Well, I guess on China generally, I'd say three things. One is you need to know that it's stubborn. It's been up over 6% now, and so if you look at the CPI data, it can't be data that gives Chinese leaders a lot of comfort. Having said that, they've had a lot of tools in the toolkit, and that's really the second thing I'd say. Whether it's rate hikes or playing around with bank reserve ratio requirements, or even using the monetary tool, food supply releases, price caps, and they haven't entirely pulled the thread on all of those. So the last thing I'd say is that because inflation has deeply political implications in China, they remain sensitive to it. It's stubborn, and so I think we're still in the middle of a period in which the Chinese are going to be continuing on the path they've been on for the last couple of quarters.
Earlier this morning on Bloomberg Surveillance, I spoke with Ellen Zentner of Nomura Securities. I asked her, are we losing those jobs to Asia?
I think it's been a very long-term trend that we've been losing jobs to other countries around the world and not just Asia. But it all goes back to, what are we going to do about our business environment here in the U.S.?
Ellen Zettner from Nomura International. So, you know, the idea of jobs and the dynamics here. One is a much more mature banking system. In your research on China, what do we need to know about their banking system? Is it a good competitor to our, what I perceive, more sophisticated banks?
Well, the first thing about financial policy in China is that it's really a tool to serve the industrial policy goals of the state. And so, you know, if you think about the challenge they have on rebalancing, one thing they're going to have to do is alter their capital markets so that capital allocation is not so concentrated in the corporate sector, but is much more available to households and the private sector. But to do that is going to require reforms that really are going to meet a lot of resistance from entrenched industrial interests and government interests. So I'm not very optimistic on that score. I think of all the challenges they're facing, this is one that's going to be very difficult,
Evan,
to see very fundamental changes.
Right, critically, I like that idea. Critically, the idea that they will reform their capital flows so we can move money in there easier and their people can move money out, you don't see that coming?
Well, I think there are things happening in terms of the financial sector in China. You know, they're playing around with the corporate bond market, so they may expand listing options. There's been talk of OTC markets, but you know, the real fundamentals of the system, which is to use the banks as a tool for industrial policy, that's really something that's going to be very difficult to break. And you know, frankly, that nexus between industrial power players and financial sector players in China is one of the most powerful parts of the Chinese system. So if you go back to where we talked about workers before, you know, how do you put more money in people's pockets? One way is that if you want a China that consumes more and produces less, they'll have to build up social welfare functions. Right. And that means getting state companies to plow dividend payments back into social security funds. That's something they're going to resist. So it's going to come down to politics, including in the financial sector.
Let's leave
I'm
it
not
there.
that optimistic.
Well, thank you. Evan Feigenbaum, Eurasia Group on China.